At the same time, you have to understand the value in deal one is the education.
Welcome to the Freedom Real Estate Podcast with your boy, Andrew Freed, and I am here with Axel, straight from Valhalla, freaking 6'4". What do you must have some Viking lineage.
Yeah, my dad's from Sweden.
Oh, okay.
So there you go. Yeah, straight from the source.
There you go. There you go. So Axel has a really, really cool story. He's been a full-time investor since 2017, has done over around $100 million in transactions, owns 550 rental units, also owns a property management company that manages, I think, 750 doors. So he's doing a lot. How you doing today, Axel?
I'm doing good, man. Appreciate you having me.
Fantastic. So you're a pretty young guy. How old are you?
I'm 31. So
31.
I feel like I'm getting a little older.
Okay. But if you started in 2017, that's 8-9 years. So how old were you when you got started?
So bought deal number one in college. I was 21.
Wow.
Small 3-unit deal off Craigslist, a for sale by owner.
Okay.
Borrowed a whole bunch of money to buy it. So it's funny. I'm coming up on early March of 2016 was when I did that first deal. So coming up on 10 years, which is pretty wild to think about. Yeah.
That's pretty incredible, but I think your story is very unique where most people start on the W-2 track and then they find real estate investing, but you found it super early. Like, how did you find it? Were your family involved? And what got you into real estate investing at such a young age?
Yeah, I mean, it's a good question. So I think, I would describe myself as somebody who was always like pretty entrepreneurial. Like I was that kid who was...
Okay.
Selling baseball cards at recess. So for me, I always kind of had that bug. My parents ran a business where they sold wood grinders. So nothing to do with real estate, but I was exposed to business kind of at an early age. And long story short, how I found real estate was back in high school and then early college. I was buying and selling cars on Craigslist. So flipping cars. And I remember getting towards the end of college and thinking about, what comes next? Am I getting a job? Is there some other business that I can get involved in? Mm-hmm. And maybe, I can't remember, I might have gotten like an Instagram ad or was watching an episode of like Flip or Flop on HGTV or something like that. And basically became exposed to house flipping and real estate investing as an extension of that. So this is back junior year of college. I'm like, flipping houses seems like the logical next step above flipping cars. And so I started learning about real estate, found Bigger Pockets, found all the podcasts and YouTube channels and all that stuff, and just started consuming all the real estate education that I could find. And what I ended up finding, through that process was flipping seems to be like a great, business model, but it's very much you do the work once, you get paid once, but you're not really building anything.
It's a job.
It's a job. It's a high-paying job if you do it well. But there's a lot of risk associated with it. It's, for me, I was never gonna be like the interior design guy. I really wasn't a construction guy. I was more like a, find kind of deals and put the money together type of guy in terms of like where I wanted to be spending my time. And that's what led me to rental real estate, multifamily real estate, all of that. And then the objective was, how do I build a rental portfolio without a job, without really any money. I had some money saved up from buying and selling cars, but from there was like, how do I find great deals, and then who's gonna lend me the money to go buy them, and that's where I started.
So your first foray into entrepreneurship, where you were a flipper, you first started flipping baseball cards, and then you upgraded to cars, and then you made the jump to investing, right? So what did your first deal look like, and where did you even find the money? You were in college, like, how the hell did you get enough money to buy the property?
Yeah, so I had, so at the time, like I was, as I mentioned, I was buying and selling cars on Craigslist. That's where I go to Craigslist to find deals. So you can go on Craigslist, you can go to the for sale by owner for real estate, and I just started browsing that while watching, Patriots games on Sundays. I'm like, let's go and look at what people are selling. So I grew up in a town called Chester, New Hampshire, a small town in southern New Hampshire. And one day I'm on Craigslist, and there's a 3-unit for sale in Chester, New Hampshire. Just the owner listing it himself, talking about how he's getting old and he wants to sell it and whatever, move on. And this is like, mid 2010s, late 2010s. Like there's a lot of people posting stuff or posting real estate deals on Craigslist. Like, believe it or not, now it's a thing of the past more so. But at the time, there was a lot of deals to be found there, or just opportunities, sellers, to speak to there. So called them up, walked it, came up with a price at the time from a money standpoint. I had an internship. I had a really good internship at this local kind of angel investment group in Manchester, New Hampshire.
Oh, okay.
It's basically like 10, 15 guys who get together on a monthly basis. They would, listen to startups come in and pitch, and they basically invested their money in like seed stage startups.
Very early. Very, very early.
Very early. Yeah, a whole bunch of guys who are trying to fund, ideas and get them off the ground. So
that was like a good entrepreneurial environment to be around at a young age.
Exactly. And I was just in a room with a lot of guys and gals who had a couple bucks. One of the guys that I met through that did some private money lending to real estate investors, like guys who flipped houses. So I kind of built a relationship with him over a period of months, just talking about like, hey, I'm trying to buy a building. He's like, yeah, if you find a good deal, we'll talk about maybe lending it to you. And back then when I was thinking about it, for me, it really felt like he was doing me a favor, right? So I was like, appreciated that. I took this deal that I found on Craigslist. I was like, I think this is the right number. Here's all the comps in terms of like what I think it's going to be worth right now. It's going to cash flow even with the high interest debt.
Yep.
I'm just going to fund the renovations out of pocket. And that's how we put together, or I should say, I put together that first one. Was he came in at the 12% and 2 points, 90% loan to value. The rest of all the dollars I had went to that other 10. And then it was putting some materials on credit cards and, turning units out of the cash flow. And at the time, I got my real estate license and I, brokered a couple deals while I was still in college. And everything was just going to, fund the business plan on that first one. But that's how you get the snowball rolling down the hill.
Okay. So you got that flip. You ended up selling it. What did you sell it for? What did you buy it for? What did you sell it for?
So it did not go that well. So so here's a fun story, right? So it was private well, private septic, and the septic tank was too small. And I was like, you know what? When I go to sell it, I'm gonna, access a unit, try to sell it to an owner occupant who's gonna go move in. And so I bought it for $195.
Yep.
A year later, I'm going to sell it. I have it listed at $275. I turned one of the apartments, maybe spent 12, 15 grand at the time. Cash flowed. A little bit along the way, more or less just a break even with the hard money. And I was representing myself because I have my license, so I personally listed it. And just crickets when I went to go sell it. And part of the reason was a buyer couldn't come in and get an FHA loan because the construction was wonky. It was 120 years old with these, messed up kind of support joists in the basement, and the foundation was like a combination of brick and granite and fieldstone. It had a small septic tank. So there's a whole bunch of little stuff around the edges that just DQ'd it from FHA financing. So long story short, I had to sell it to an investor, and I ended up selling it like a little over 200 grand. I basically, it was a little less than a break even. I lost like $5 on the whole thing over the first year, which at the time felt like a big punch in the gut. But the education from it was, pretty invaluable, and it allowed me to, act confidently on the second, third, fifth deal after that.
It's funny because you think you would learn the most from your successful deals, but you actually learn the most from the deals that don't go too well.
Yes, exactly. And I think specific to real estate, real estate, as any investing is, it's more about not losing money than really making money, right? It's when you think about how hard it is to recoup money that you lose, you gotta get into deals that go really well to make up for the dollars that you lose. So for me, it was like a big lesson in, you got to think about what your exit's going to be before you buy the place. Who are you going to sell to, and what kind of financing are they going to get? Are they going to be able to buy it, et cetera, et cetera? Do a little bit more due diligence when you buy on the front end, some other things to look out for. It was also just a challenge for me being like an early 20s guy doing like, property management. I very quickly realized that wasn't like right after that, I hired a property management company. I was like, I want to spend time on finding great deals, putting them together in a way that reduces the amount of money I need to invest in them. I don't really want to be involved as much on the property management construction side. It's not my skill set.
It's funny because you say you lost $5,000 on that deal, right?
Yeah.
But to me, it sounds like you made millions of dollars on that deal.
Exactly.
Right? Because you learned proper due diligence. You learn the fact that like what you're good at versus what you're not good at. You don't like doing the property management component. You like the other aspects of the real estate deal. And also think with the end in mind. What's my exit strategy, right?
Yep. 100%. And I think that's the challenge that a lot of people have with like deal one is they're waiting for that perfect opportunity, it's, as I mentioned, right? You don't want to lose money. It's important to not do a bad deal to start your whole investing journey. But at the same time, you have to understand the value in deal one is the education. It's not deal one is not going to make you rich. Deal two is not going to make you rich. Probably not even deal three. But like, it's the exercise of working through the process of underwriting and going through the transaction process and taking over the management of all the tenants that are there, meeting the vendors, the GCs, and all of that is really where you're acquiring the skills that you need to then go out and do the next 2, 5, 10, which is really where you get the results.
Yeah, I mean, I think that's a good point. That people can tell you what to do, but if you don't have that experience, if you don't experience it yourself firsthand, it's really hard to absorb the knowledge.
Exactly. Yeah, because you have nothing to really base it on, right? I mean, it's learning by doing is always the best learning you can do, or learning you can kind of achieve, right? I guess. But and the other thing too is every deal is going to have its own nuance, and it's helpful to have people in your circle that you can lean on with like a question here or there, around maybe some big decisions, like. That's important, and obviously you should get educated, and I spent a whole bunch of time getting educated before that. But like none of that prepared me for a 500-gallon septic tank being too small for a 3-unit building. Like that's one of those little tiny things that like I never would have gotten that from anybody, right? It's like I kind of had to learn that one on my own, and it's just like a weird one. So, and maybe I don't want to say never, but it's hard to get every aspect of a deal or to feel comfortable with every aspect before you pull the trigger at the end of the day.
And I mean, you bring up a good point with the septic. Like I had the same scenario. I didn't know that until I bought a property. The septic was too small based off the bedroom count. I'm like, oh crap.
Yeah, and it's like, and it's one of those things where let's say you ask 3 guys like their opinion on that. Maybe they've only bought deals with public utilities and they don't know, right? So it's kind of hard to keep an eye out for that stuff. And just generally speaking too, the best you want to have the people in your circle who have been there, but you want to be able to ask them questions about what you're doing as you're doing it, not like questions about what you should be doing before you do anything, right? Because it's really hard for somebody to commit to really wanting to help you if you're not making progress, as an aside too, just from like a mentorship standpoint.
Yeah, I mean, you bring up a lot of good points, and I mean, going from 2017 from that first flip to over 550 doors, people think that's a huge dramatic shift, but I think one of the hidden lessons there is you probably found mentors along the way, right? So who's one of the main mentors you found along the way, and what did you do to actually get that person to become your mentor? Because asking somebody to become your mentor, it's not that easy, right?
Yeah, that's a great question. It's funny. I never really had like one individual who was really like the person I would go to with questions. Like as I continued to grow, most of the time that I spent from an educational standpoint was just generic like podcasts and just listening to content like that. That said, there were a couple of key inflection points I think along the way that stick out to me as where I like kind of sought out help, right? I remember the first big one was I joined this online, networking group as it relates to raising capital. It's called Raise Masters. I'm not a part of it anymore, but this was 4 years ago. It was a paid group. Cost a couple bucks to get involved, but for me at the time, this is back in 2021, I was like, the future of the business for me is I'm going to start raising capital from investors to go out there and scale the business, to go buy more buildings, to pour gas on the fire, to do more deals, and to really grow the portfolio outside of just me using my own dollars and cents.
And what did your business look like at that point in time?
So I think at that point, I grew a personal portfolio of like 80, 90 doors.
So you had 89 doors and you joined this mastermind.
Joined this group, and I was like, this is how I'm going to go from buying 20, 30 units a year to 100, 200 units a year, right? Is we're going to have to start getting more dollars involved outside of me just taking on a ton of debt on every single deal I'm doing, which just made it harder to sleep at night, frankly.
Totally.
So joined this group because I was like, there's a whole bunch of stuff I don't know about this. How, where do we go meet the investors? How do I legally raise the money and stay compliant on that side? What are the best practices from like an investor relations standpoint? How do I build my business to scale faster from a capital standpoint? All of the different things that are introduced as you got to figure all this stuff out before you do that was something where like I didn't really have a ton of folks in my close network that had done that. So I was like, I got to go out and find these groups or find these people. So at that time, I was very intentional about joining groups of people who had already done that were comprised of folks like that, whether it was doing bigger deals or doing or raising money to do deals. And then I would just get involved and I would just extract the most value I could out of it, right?
So you found successful people doing what you wanted to do and found a way to surround yourself with them, in this particular case in the form of a paid mastermind.
Exactly, yeah. So it was almost like it takes a village type of thing, right?
Totally.
And for me, it was, I had a couple of folks locally who were, I would say, like 10 steps down the road, but they didn't really scale. It's funny. I think the advice that you can get, and I'm trying to think about the best way to put this. I think the advice that you get from people who are no longer in kind of your stage of where you're at, you oftentimes have to take it with a grain of salt, right? So at that time, I was mid to late 20s. I was 26, 27.
Yep.
A lot of the people that I knew who owned 1,000+ units and had raised money from investors were 50, 60 years old in the local market.
Mm-hmm.
And they had opinions about what I should do, but they also made that shift in their business 30 years prior in a completely different landscape.
Totally.
And while some pieces of advice were beneficial, a lot of it was just out of context for me, right? It was like, for me, like I raised a lot of money through the podcast that I host, raised a lot of money through posting on Instagram, raised a lot of money from like these cold kind of marketing channels, which was not a thing 20, 30 years ago.
Absolutely.
And I think, for me, I personally had a slightly different risk profile myself, right? I was willing to invest a lot more money in the deals that I did. I was willing to, kind of structure things a little differently with the investors that I worked with versus the guy who's been doing it for 30 years, right? Which is a lot of the local folks that I kind of went to for advice at the time. So I was like, I got to get around the people that are kind of around my age, around my stage of growth, who are like 2 steps ahead of me versus 25 steps ahead of me. So for me, that was something I was, really conscious about at the time because it was a little bit more contextually important for me to find those types of people.
Yeah, that's a super smart approach. And I took the same approach when I joined GoBundance, which is a mastermind, and they have the whole group is mostly real estate investors. And you can find any real estate investor at any different stage in their career. And to your point, it's very important to get knowledge from people who are 1, 2, 3 stages ahead versus 10, because they literally simply lose concept of what it's like. Like you and I, when we first started, we grinded like hell, right?
Yeah.
Like if you put our same mindset into that position now, I guarantee we would approach the situation completely in a different manner, and mostly more from a CEO perspective, less from a doer perspective.
Yeah, and I think a very simple tactical example of that is the hypothetical. I keep using age, but I think it illustrates the point well. Like a 50, 60-year-old investor who's been doing this for 20, 30 years, and their primary goal above all else is reducing risk, reducing downside, preserving the capital that they have. And as a result, maybe they're only, they'll never buy a deal ever with higher than 70% loan to value or something like that.
Yep.
Well, if you're 23, 26, 28 years old and you're just getting started and you're looking for that first deal, well, you're probably going to have to use more debt than that to get into that first deal, right? Like that's the only option you have.
95, 97%.
And if you listen to that person's advice, well, then you're probably just going to take a lot longer to get going.
Totally.
When in reality, like my advice to anybody listening who's like early mid-20s is like you can take an absurd amount of risk with your own money, right?
Totally.
Don't risk a whole bunch of other people's money that you raise or anything like that. But for yourself, like you can go in there and swing the hammer on the weekends and install the flooring yourself or whatever you got to do. Like let's say the deal goes wrong and you lose your money. Well, you got 30, 40 years to make it back. And you've also paid for that education that we talked about at the beginning of this whole conversation. So for you, you got to think about all of these decisions through a totally different lens than the guy who's been there, done that, and is now just trying to protect what they have.
I think you bring up a lot of good points. I think one of the main points I see in that is you're talking about when you're trying to build wealth is very much about concentration in an asset versus when you already obtain wealth. It's about protecting that, and you protect it. You give up returns, but you protect in the form of diversification, right?
Exactly. Yeah, and it can be hard to understand that nuance, like as a new person, and you're asking for these, this advice from a lot of these different people who are objectively successful, who have been there, etc. But oftentimes you have to understand that like you want to take the advice that's applicable to your situation, which, when you're getting started, it's like you got to scrape and claw and do whatever you can to just accumulate some assets, like just make some progress and just get the whole thing rolling, right? And oftentimes that means you're going to take a little bit more risk, and that's how it should be. That's how the guy or gal who's 60 with a big portfolio, that's probably what they did when they were 25, 30 years prior.
So when it comes to getting a lot of units and doing larger deals, a lot of it's a team sport, right? And I think one of your main roles in this team sport is you've been the deal finder. You've been the off-market specialist, right? So, when it comes to being an off-market specialist, what are some tactics you utilize to grow your portfolio? And what are some best practices you recommend for our audience?
Yeah, right. We do a lot of direct seller marketing prospecting to find deals. And for context, like the primary kind of range of deals in terms of what we're buying is 5 to 75 units. We've done some slightly bigger ones. We'll buy 2 to 4 unit deals here and there, but primarily it's 5 to 75 unit multifamily deals, Southern New Hampshire. That's our criteria, which adds some context to everything I'll say after that. But the way I think about it is we want to build a funnel, right? And there's deals can come from any number of sources. They can come through brokers, or you can find them, publicly listed on the MLS or LoopNet or wherever. They can come through referrals, which could be service providers. That could be like other investors who know what you're looking for, wholesalers, stuff like that.
Okay.
Or they can come through direct-to-seller marketing and prospecting, right? Where you're reaching out to the seller or marketing to that seller to start a conversation.
Okay.
So what we want to do is maximize all three. And part of how we do that is by focusing on the direct-to-seller side, which is where we can exchange time and dollars to acquire leads, to go talk to sellers. That's the direct mail marketing. That's the cold calling. That's the cold emailing owners. But at the end of the day, what you want to do is do that in conjunction with building your presence in the market that you buy. And there's a whole number of ways to do that, right? I think that the biggest and easiest thing that you can do is just start posting in some public medium, whether that's Instagram or on Facebook, or you start an email list that you add all the contacts that you meet through all the brokers that you talk to, all the lenders, all the all the title company attorneys, all the other investors.
Yep.
You send out a newsletter, you post online every once in a while, and that's effort that is scalable, right? You send out one email to 100 people. You don't have to invest that much time to do that, and people are aware of what you're doing and what you're buying. And while you do that, that's when you're going out there and trying to hunt deals, as more of a kind of a sniper, right? So I have an acquisitions manager who cold calls all the properties that kind of fall on our data list, tries to establish relationships with the owners, introduces us, what we do. Hey, we'd like to make you an offer, like to learn more about the property. If you don't want to sell, that's cool. Just let them meet another investor in the market. And while we do that, we send mail 4 times a year. We send it quarterly. And that means we control our deal flow a little bit more, and that we can make offers through just folks that call us from our mail piece, or folks that we reach out to and cold call and establish a relationship with. And then while that's happening, we're building our presence in the marketplace so that we're more top of mind when, Joe the wholesaler, or Tim the lender, or Sue the title company attorney, finds out that someone's looking to sell, and they remember, hey, Axel and his team buy 5 to 75 unit buildings in Southern New Hampshire. Let's I'll try to connect these guys. And then we're further building our deal flow above and beyond just trying to wait for the brokers to send us stuff.
So your main value in some of this, in scaling this large portfolio, has been creating a marketing machine, right? Either direct to seller, or essentially coming up with systems and processes to ensure consistent automated follow-up with sellers, but simultaneously you want to be at the top of people's mind. And I do that very much the same with social media content. And what I love about social media is evergreen marketing, right? Yep. You post once, it's completely free, and it's there forever. Versus direct to seller marketing, you send one postcard at $1, it's gone forever. That postcard doesn't keep getting sent to the same person.
Exactly. Yeah, and that's why I think it's really important to have a couple of different approaches, right? I always say, there's a lot of investors. A lot is a relative term, but there's many folks who are doing one type of prospecting or marketing, right? Yep. A lot of people who are only sending direct mail. Or there's a lot of people who are only cold calling owners, or they're only doing some type of cold texting or something like that. Sure. There's not that many that are doing 2, and there's hardly any that do 3+, right? And, channels would be the industry term, right? We send cold emails to owners, we cold call owners, and we send direct mail. So we're going to hit their laptop, their phone, and their actual physical mailbox. So we do a lot of things that are active, but as you mentioned, that doesn't scale over time. Like the creating some content scales over time. And also at the end of the day, especially when you start pursuing larger deals, over time, we continue raising our minimum deal size as to what we want to do. And we want to spend more of our time doing the 50, 70, 80, 100 unit deals than the smaller stuff. Totally. And those deals are typically going to come through some type of relationship with someone versus a cold call.
Definitely.
We have bought some bigger deals through direct to seller marketing, prospecting. We did a 72 unit deal about a year and a half ago from a mail piece. But the vast majority of those deals are going to be, they're going to be brokered. But the ones that aren't are going to be, this investor knows this seller and tries to, refer it, and maybe you kind of partner on the deal and you put it together like that. And the only way to increase the likelihood that people think of you is to be more top of mind. So send a lot of emails to our list, valuable content. Here's some data around the New Hampshire market. Here's some information that might be relevant to you. here's some updates around our business, stuff that gets people to want to open the email that we send them on a monthly basis. And then we're doing all this stuff online where we're creating content, and, the before and after pictures of our unit renovations, the just closed announcements, the whatever. And that's what allows us, without having to spend all this time to reach out individually to all these people that we want to build the relationships with and text them or email them or call them and saying, hey, just a heads up, we're still looking for stuff. All the social stuff is what allows us to stay at top of mind.
And I think you bring up a really important point there. When it comes to social media, it's not about selling anybody anything. It's about simply providing value.
Yeah.
And know if you provide enough value to the world will provide the value back to you, And I think that's the way you operate. That's the way I operate. And I think that's the way successful, capital allocators do operate, right? And I think the important thing about your story is you went from like 0 to 500, 600 doors very, very quickly. But I think the reason you did that was because you took a very smart approach to syndication, where you brought so much value. You became the point person when it comes to raising capital. You became the point person when it comes to finding the deal. You brought so many angles to the deal, where when you're part of the deal is just that much easier to close.
Yeah, and I think part of scaling too is you get the big three functions in a real estate business, right? You have the acquisition side, which is finding the deals, regardless of where they come from, right? Totally. It's finding deals.
Yeah.
You've got the finance component of the business, which is who's going to be your lender, or where's the actual capital to close outside of the debt coming from?
Totally.
Is that your money? Is that investor money? Whatever. And then you have the operations, and that's the actual management, property management, and asset management of the deal. So for me, it's we got the acquisition side pretty figured out. We got more deals than we have money, so now we got to go solve the money side.
Yes.
And for me, it was I can keep doing deals with my own money, but I'm going to hit a cap. Even if you're buying killer deals, and you can refi all your money out plus then some within a year, you're still going to be constrained by the amount of money you can spend on renovations, put down on earnest money deposits, all that stuff, right? And I hit that wall. And so for me, it was I just have to bring in other people's money to keep this thing going. And syndication for me was the right way to do it, in that I didn't really want to partner with a bunch of different people like as active partners. I still wanted to control most of the decision making, and that was just a goal of mine, and for me and my business. So we'll go raise $50, $100, $200,000 checks from limited partners. We'll do all this in a compliant way. They can invest in the deal. I'm still the manager and the decision maker. I'll still co-invest alongside them. But if the deal goes really well, I have an outsized percentage of the upside in the deal, but I'm allowing myself to do more of the deals that we find. And that was really the reason behind it. And, for me, that, like I said at the top of the show, that's really where my skill set was the marketing and the sales around finding the good deals, and then the marketing and the sales around finding the investors and allowing, the business to grow faster that way.
You created such a strong marketing machine that you had too much opportunity and not enough capital, right?
Yes.
And I've ran into that situation myself. And, when it comes to scaling, ultimately, if a good opportunity comes across your desk, and you don't have the money, you're going to find a way to close it.
Yeah. And it's a good position to be in, frankly, right?
Totally.
And I think that there are different points in time in a market cycle where deals may be a little bit easier to find than money at certain points in time. And then there's other times where deals are, harder to find, but the money's abundant. And real estate ebbs and flows like any business, or as the economy does, fundamentally speaking. So you want to make sure that you're balancing both and spending time on growing both, right? Because while you may have a ton of deals and you may have a ton of money at one point in time, you may start to lose some capital, you may start to lose some deals. You always want to be spending time developing both, even before you need to. So for me, it was one of the things I would have done earlier was just start trying to speak with investors before I even knew I had to raise the money, so that I had these warm relationships with folks, so that when I really started to hit a wall myself, I could tap in and bring some people in. Because for me, it's there was a long period of time, probably 9 months, a year, where I had to just let a lot of deals go because I just didn't have the investors in the network to pursue them. And if I were to do that over again, I probably would have just started to develop those relationships with more folks, so that when the time did come to where I needed to bring them in, I had more of an access to it.
Yeah, but I think your development brings up an important point where it's there's three spigots of real estate. How you reference like finding the deal, operating the deal, and the capital. And over time, you develop system and processes to maximize each of the spigots, right? I think the first was you became an off-market specialist, and then the next was you figured out how to raise capital, and then the third, which we'll talk about, is you became a vertical integrated operator and you developed a property management company. So talk a little bit about that.
Yeah, so this was driven somewhat out of need, but more so out of knowing like long term where the business was going. So back in 2020, like I think we, kind of around that 70, 80, 90 unit mark was where I started to realize maybe the need for this. And at the time I was working with a third party management company who was doing an okay job. They weren't terrible. They weren't great. It was fine. It was one of those where they're allowing me to spend most of my time on finding the deals. Maybe I'm paying a little bit too much on renos and the vacancy is a little too long, but whatever. I just want to be spending my time finding deals.
Totally.
But I knew if we were going to get to 500, 750, 1,000 units, I need to control more of this process. And the other piece of it too is it makes it a lot easier to raise money when you are doing your own management versus outsourcing it to a third party. Like, especially nowadays, like limited partners and investors, they want to know who's actually operating the deal, right? And they like to see a company that's doing both, right? They're finding the deals, they're putting together the money, and they're operating themselves, a vertically integrated one. So at the time, I found a great business partner who was actually an employee of the management company that I was working on the third party side with.
Okay.
Him and I teamed up with another silent business partner and basically started our own management company with my properties being the seed, kind of property or properties or portfolio for that management company. And then I brought in a few folks I knew in the marketplace, like brought in their business. So we basically launched with 100 units under management. And there's some challenges with that, right? It's a lot easier to start a management company with a few hundred units because you can afford to hire that team up front and develop the systems a little faster. But we really bootstrapped it. We started with 100, and my business partner really wanted to do third party management as well, so that his ownership interest in this new management company, grew faster. And basically myself, like I like to refer to myself as like our biggest third party management client. But at the same time, I'm still paying the management company as a separate business, right? So it's like I get the benefits of being vertically integrated, but we also have another line of business where we're going out there and doing third-party management for other investors in Southern New Hampshire. And, it was one of the most important decisions, I think, looking back, that we made. Not to say that it was easy. It was really challenging.
Totally.
And I think that the really important component of it for me was, as we've talked about, like I want to spend my time on the finding deals and the raising money side. Like I have the ability to asset manage really well, and I understand how to implement a business plan conceptually and all of that. But at the same time, like I don't want to be spending time like managing the contractors and the units and working through the process of working through the leasing process and doing all of that. Like I'd rather guide the ship than like be in the trenches doing that, because I think my time is better spent elsewhere. So establishing a relationship with my business partner, Ryan, who I started this with and who runs the day-to-day, was huge, because he can run the office and run our whole team. I can be there in an advisory role, kind of guiding the direction of the actual business itself alongside him. And I can still spend most of my time on what I enjoy working on, which has been great.
Yeah, so I think the cool thing there is like, you will, what I like about being vertically integrated with property management is you align property management with asset management, because I think the main issue I think most real estate investors run across with third-party property managers, which they don't really talk about, is incentives aren't aligned.
Yeah.
Or a lot of times they're incentivized to make the most money off of you, and you as a real estate investor are incentivized to get the highest return, right? So now that you own a piece of this company, your asset management philosophy very much feeds into how they run the org, right?
It does, absolutely. Yeah. And, I think one of the values of being involved in the management company, like as an owner operator of real estate, is I can disseminate that, just that viewpoint on the property management process to everybody in the business, right?
Absolutely.
So we spend a lot of time training our team. Like, yes, you're a maintenance manager, you're a leasing agent, you're our project manager managing unit turns, and that's what you work on a day-to-day basis. But I'm going to try to help you think like an owner with a lot of this stuff, which for our third-party management clients who hire the management company really start to appreciate, because as you mentioned, right, there are all kinds of decisions you make throughout the life cycle of owning a property that are really important as it relates to the downstream effect it has on the property value, right?
Absolutely.
One being an example of like, do you reduce the base rent on a unit, or do you introduce like some type of concession, half a month off first month's rent? that keep that base rent high, because the owner is going to look to refinance it soon because they just bought it.
Exactly.
And you want to keep that rent roll nice and high. When we're thinking about like the ROI of, do we put a dishwasher in this unit versus we don't put a dishwasher in? Well, our leasing team says we can get another $25 a month. It's going to be another, whatever that is on an annual basis, a few $100. It's going to cost $1,000 to install the dishwasher. That's 30%. But when you start to look at the bottom line and a cap rate, well, that adds a lot of value to the property. And it's like, we try to instill that thought process on the whole team, which outside of just me being the one to make asset management related decisions, I've got everybody kind of rowing in the same boat. Exactly. Versus just thinking about stuff in a very narrow, kind of capacity.
Yeah, it's a really good point. So, we're probably going to start wrapping this up. So just to give our audience a little bit of insight into, some successful strategies you've implemented, think back to when you were a kid and think of 3 pieces of advice you would give to yourself to be successful today.
That's a good one. One of them I think is embrace having like a narrow focus and like a long-term narrow focus paired with like a lot of patience. Okay. An example of me not doing that, which is why I learned this lesson, is back in 2021, the craze of the market and everybody who was doing deals in markets outside of New England. Like New Hampshire was performing really well for us. We were doing great deals in New Hampshire. But at the time, it was like people are moving to Florida, people are moving to North Carolina, South Carolina, Arizona, Texas. And at the time, I also wanted to start raising money to pursue deals. And we did a few deals in Florida. Like we ventured into a new market, did 3 deals between 16 and 50 units in size down in Central Florida. 2 of them went well. We're selling the 3rd. We'll do okay on it. But it took so much of my focus away from what was just humming in New Hampshire, right? We were finding great deals. We were operating them really well. Totally. And I just moved away from that and started focusing on something else. I got the shiny object syndrome. So a tip I always have for folks is like, just embrace having a really narrow focus and try to block out as much noise as you can so that you can let time help you, right? So I think that's number 1. Number 2 is be really honest with yourself about what your strengths are and then just triple down on those early. And that was, me early, where I was like, I'm not going to be the guy who's standing in the kitchen thinking about, we should blow down that wall and use these counters and do these lights and do these countertops. I was like, that's not me. I'm not going to flip houses. That's how I got into real estate. I was like, I'm going to flip houses. I'm going to be a house flipper. Totally. And I very quickly realized like my skill set doesn't really align with that. I'm much better off like finding deals that are really easy. It's not hard to renovate an apartment, right? You're going to do the same thing in every single one, broadly speaking, assuming you're in the same market. So for me, like that was a much more closely aligned, way to put my, kind of apply my skill set. And then number 3 was be really comfortable with taking risk, right? I think I took a ton of risk in my early to mid 20s. That's why I grew quickly. Frankly, I used a ton of debt, which is like, there is risk associated with that. Used a lot of debt, rolled every dollar back into the business. It was, I'm not going to lie and say it was helpful that the market was growing at the time. But at the same time, I was finding really, really good deals, right? And I think that was the one thing that I control, was like I was finding great deals. I was taking on a lot of debt that I was comfortable with, because I always came back to the downside being, I'm 25, I live with 3 guys in Dorchester, my rent's $1,100 a month. Like, that's fine. If I go to 0 now, I'm in the same spot I was 2-3 years ago. Nothing's going to change long term in my life whatsoever. So for me, it was less about like what could go wrong and more about what could go right. Now, even just not that many years later, I should say, being like early 30s, 31. Even now, my mental chemistry is starting to change a little bit, where now I'm not as comfortable taking risk. We still take risks, and I'll still get into a hairy project that requires a lot of renovations here and there, and still do a deal sight unseen with my own money. But now it's very much more, now I want to start to build a sound foundation longer term, because I have less time to correct the ship or right the ship. And I'm sure, I don't have kids right now, but the second I do have kids, like, then that's going to even more completely change, right? So if you're in a life position where you can embrace risk-taking, you can embrace kind of making some of those decisions that somebody who's in their mid-30s, mid-40s, early 50s with kids and a life that can't go as awry, in terms of the risk they can take, you should be embracing that. So, and that'd be number 3.
Those are all fantastic tips. Our audience got a ton of value out of that. So for people that want to learn more about you, where can they find you? Where can they listen to your podcast? Where can they possibly invest in your deals?
So the podcast is the Multifamily Wealth Podcast, Spotify, iTunes. At Multifamily Wealth is the Instagram account where I'm posting there all the time. If you want to reach out to me, Axel, AXEL, at alignedrep.com. And if you go to our website, there's all kinds of opt-ins there. If you want to get on our email list, if you click the invest button and put you on our investor list, if you want to get a peek at what we're doing here.
Cool. So that was honestly a fantastic blueprint on how to build an acquisition machine, how to build a property management machine, how to become an expert capital raiser. Those are the 3 skills you need to scale a portfolio quickly in real estate. Axel's a perfect example of that. I just want to thank Axel for coming along, teaching us some really cool strategies. And I just want to thank our audience for listening. Take care and have a good one.